Well, hi. It's been a while since my last video. Apologies for that. I've been busy with some research and projects with regards to my some graduate work that I was doing. Um, but I before I talk about tax considerations, especially as part of the investment policy statement, I did want to touch on, one other thing, especially when it comes to managed accounts. And for many of you that actually have managed accounts where you're actually paying a fee to the person actually managing that account, whenever they're telling you about their gains or how they've done, they should also be able to show to you what it would have been based on some comparable index that's out there. And again, there's a comparable for every type of investment, for most investments, unless you're getting into some very exotic type investments. But they should be able to tell you what the comparable is. So if I'm managing an account and I'm investing in companies within the S&P 500, and I'm simply choosing the best companies that I think are going to do very well for the next 6 months or 12 months, uh, then I should be compared to the return of the S&P 500, the overall return of the S&P 500. And if I'm not doing better than the S&P 500, then I am not doing well at all. I am not giving you as much of a return as you should be getting. And if anything, you'd be better off actually just investing on a passive fund that actually invests in the S&P 500. And again, it can be very specific sectors. It can be combinations of sectors. It can be bonds. There is a comparable for everything. And again, your advisor should be telling you, should be giving you what the comparison is to those indexes or those comparable investments that could be done elsewhere. And if they're not, then that's not a good thing. That's really not a good thing. It's something that I would, and if anything, if he's not doing that, then you probably should think of maybe doing something else and maybe having your own account. Um, so that's that. Now I want to talk about tax considerations, and I'm only touching on a very small part of this. This is a very elaborate uh, part of the investment, policy statement. And depending on what you have and the different things you have, it can be quite complex. And so again, this is not meant to teach everything. And again, in other videos, I will go into maybe some very specific areas, especially if you've got very concentrated positions and what you can do. But not in this video. I just want to touch on a few things. So number one is, the type of investments or type of savings that you're doing. If it's in taxable accounts, then obviously whenever you sell and whatever income is coming from that taxable account, and that's going to be taxed. And so you need to be taking that into consideration. If you're putting your money into tax deferred accounts, which are great, and you should be doing that. In fact, you should be maximizing on that. That will actually save you quite a bit because again, you're not paying immediate taxes. And if anything, on those savings that you are actually getting from by not having to pay the tax right away, that's allowing that money to continue growing and generating more investment value. So that's a great thing. Maximize that as much as you can. Obviously, when it comes to taxes, there are many different kinds of taxes on your gains. Again, whether short term or long term, again, that's going to create a different tax uh, percentage. A dividend, obviously, there are dividend tax rates, and there is also interest taxation. If you have bonds and they're generating income, depending on the type of bond, you may be taxed. You may be taxed locally as well, or at the state level, as well as at the government level. And you may have some where you don't actually get taxed at the federal government level. And you may have some where, again, you also don't get taxed at the state level. So all those things need to be taken into consideration. Tax loss harvesting and asset location strategies. Those are important because, no account or, no investment's going to be perfect. And so you may get into some losses. And when you do have a loss, you want to take that loss and use it against the gain. because if you do that, obviously that will offset the gain and you won't have to pay as much taxes. So, and that's what tax loss harvesting is. And again, I'm not saying that's a great thing. Ultimately, you want to be having more gains than losses. Even if you're paying taxes on those gains, that's still better than having losses. So, but if you actually do have a loss, you want to take advantage of that. And again, there's so many different ways, depending on where you are on your tax profile, of what to do in investments. If you have a lot of partnerships, again, that are generating income. Again, there are many different things that you can do, and not only to offset one another, but also to try to minimize overall what you have to pay in taxes. And it can be individual strategies per investment vehicle. It can be one big tax strategy, combining all of the different investments. And again, in reality, it's going to be a combination of the two. But again, that's something that you need to do and be very aware of, especially in any investment strategy. And again, talk to a tax accountant that can help, especially he may not be telling you where to invest, but given your different investments and what you're doing, he can definitely help you in how to minimize some of the taxes. So something very, very, very key to do. And again, in other videos down the road, I will talk about very specific structures of very specific conditions or situations where you may have to do this or that, and some of the things that you can consider to offset the potential tax implications. And again, we'll dive into that more later on. Thank you, and I'll talk to you later.